I would like to start this episode by saying that sometimes I do feel like a dinosaur. I do feel out of place in 2024. Because when I look around the internet and I see all these 20-year-old supposedly YouTube traders, how they operate, what they say, what they do, okay, judging people by their actions. It's very clear we live in a very shallow and superficial world. That's a reality. At the end of the day, the truth is that these are times where people are focused on the short term, on getting as many followers as possible, on quick bucks, all these kind of things, okay? Now, back in the days, when I discovered trading financial markets, you know what I used to do, ladies and gentlemen? I went to the library, I went to Amazon, I ordered every single book on the topic of trading, everything which was out there, okay? Boxes and boxes of books. I tried to read everything, all the work people before me have put out there. I did a lot of research. I researched the history of trading, which people have been there before me. What can I learn from their journeys, okay? What were big successes? What were failures? Who did what? Okay, I really went a dig deep. And that's the mindset I have until today. Without that mindset, I would have never, ever been able to discover and publish the market causality. Can you imagine the degree of dedication which was necessary in order to enable me to do all that? And I guess I have to accept we live in a time where people don't go deep. They just try to get the most out of the least amount of work. And I can't identify with that at all. My whole life path has been different, okay? I rather follow stoic thinking. I always digged deep, I did research, I always went as far as I could. And you can see that I may have a point here just by this video today, where I will talk about one of the most successful retail traders in the history of humankind, Mr. Paul Rotter. And as you can see, there's almost no content on that person in the internet. Why? Because nobody does research, nobody digs deep. And I also predict that after this video, suddenly some of the bigger channels will also talk about these topics, because you know who you are. Bigger channels sometimes like to see the content of smaller channels and just try to monetize it by rehashing, summarizing the content and all these things. That's the spirit of today, and I'm against it. I'm not part of this whole development. I come from a different background, okay? And my personal mindset was always different. To talk a bit about that, and maybe that's a good moment to do so. You know, when I started studying economics, I locked myself away in the library. I was the first who arrived and the last to leave the library before it closed. I was studying 10, 11, 12 hours per day, Saturday, Sundays included. I tried to be like a sponge to absorb as much knowledge as possible, to go all the way. I took extra courses which I didn't need to, which didn't give me credits, just to gain more knowledge. And when it comes to trading, especially short-term trading, one of the most complex and difficult activities on this planet, you will do well in having that kind of mindset and attitude. Any type of short-term thinking will not get you anywhere. You see what happens. People just destroy their reputation, blow up, okay, and inflict harm on themselves and others. Anyway, so with these points out of the way, let's look at this fascinating case. I should say that Paul Rotter, who's German, seems to be quite secretive. He is not interested in having a lot of information on him out there. A few years ago, I had a very, very brief contact with him. Unfortunately, it didn't lead anywhere. And that's why I rather decided to make this video based on the public information out there. I should also say what I will show here. These are two interviews which are quite some years old now. One is from 2010. So 14 years is quite a while, but allow me to give you the story in one go. We are talking here about the late 80s, early 90s, where markets were different. It wasn't like today. Back then, we didn't have as many algorithms around who were dominating the markets. And you will see from this story here that may be the moment where it all also started in terms of algorithmic trading. What Rotter did is he found a way to flip, as I call it, all right? He wasn't looking predominantly at charts. He was looking at the bid and ask spreads, at the price ladder, to see all the orders at all the different prices. And what he would do, he would, for example, place a trade, all right, in one direction, and then soon after, he would cancel the trade and go in the opposite direction, pocketing 2 ticks, 3 ticks. You see, he would do that 80, 90 times per day. That's known as flipping. So back then, that was not an illegal practice, okay? It was because if he got hit on the big orders, he would need to honor them. And at the late stage of his career, that's what happened several times, where he lost a few million and then he stopped the strategy. We come to that. But for a while, for several years, this flipping, this order book scalping, as you would probably call it today, worked very well, and he made a massive fortune. I have heard that he has turned around 10,000 euros into more than 300 million. Can you imagine? Over just a few years. Now, there are many rumors and stories told by only experienced traders, not by YouTube wannabe traders, 20-year-old influencers, but by people who actually have dedicated themselves in a more serious manner to the craft, that Rotter was even threatened, he was approached by the banks and all that. Because in a nutshell, what happened here is the following. At some point, after Rotter became very big with his trading, and I think at some point he had like more than 20% of the Eurex, and he used futures to do the flipping. So remember, this is a centralized market. But at some point the banks realized what's going on, and then they started creating algorithms to make sure that his orders get filled. This may as well be the start of all the algorithmic trading, okay? Can you imagine? So we're talking about historical developments here. So at some point the strategy stopped working, as simple as that, okay? Because he was often filled on his initial order before he could even flip and cancel it and go on the other side. So then it stopped, okay? And from there on, he never could trade that way again. As far as I know, never ever again. He got more on the investment side later on. But this kind of short-term style was pretty much over. Now, for the ones who do the research, you know that there are very few people out there who still do order book scalping. I remember there was John who had a website, but it was different setups. It was not flipping. You would also read the order book in the futures market and then also do little scalps. But this was not really like the flipping approach from Rotter. So, as a trader, you of course have to look at those cases. If this is one of the most successful retail traders in history, it will do you well analyzing, researching, reading everything you can about that person and trying to understand every detail about that case. Because whatever you do in the markets, it may give you ideas for whatever you do yourself in markets. And as you will see at the end of all this, my personal opinion is that the equivalent approach from this flipping back in the days, exploiting like a market inefficiency in a way, you could argue that the market causality presented on this channel, the forex market causality, is an equivalent approach in today's day and age for the forex markets, which are fully efficient, because the market causality gives a proven edge with leading information to traders, countering the algorithmic trading, which in 2024 completely dominates the markets. You understand? So since then, it's not that the algorithmic trading went down again, it increased more and more and more, especially in forex, until forex was completely controlled by the smart money algos. You understand? So the market causality is kind of a next phase, a next period in trading history where the algos are completely efficient and we now as human traders can counter their manipulation with the right tools. You understand? It's like the end part of a movie in a way. And I wish that Rotter would be aware of that. I had once sent him several things, but I never really got a proper response. Who knows? We could have done something together or whatever. It never came to that in the end. Who knows? Maybe something happens in the future. But I tell you, if you ask me, who are your biggest idols in trading? In my top 5, there will be Paul Rotter. Because what he did in trading history is unmatched. He found this inefficiency, exploited it as much as he could to the end. After some years, it didn't work anymore, and he left and took his money, and nobody really knows exactly what he's doing. Probably some type of long-term investing or real estate, who knows. He probably still does some kind of short-term trading now and then, but I don't know that for sure. And obviously, in 2024, it's a different time. So we have those 2 interviews, and I would suggest that we really read them. Okay, and if you don't have time now, stop the video, put it on your long-term watch list. Come back and try to really understand everything which is shown here. As far as I know, these are really the 2 only interviews we have. And I will read it out for you and then I will comment. Let's start. Paul, can you tell me a bit about how you got into trading and your trading style? I started trading about 20 years ago when I was an apprentice to become a banker at a German bank in Munich. During that apprenticeship, I had already spent 1 year in the trading room at Hypovereinsbank in Munich. I was basically entering trades into the computer system for clients of the bank. There were trades that had been made over the Deutsche Terminbörse DTB, a German futures exchange as it was known back then. I then moved to Frankfurt to work for Diver Securities as a junior trader and learned by doing it. I'd never traded at this stage, so I started trading small contracts on the DAX, the main German stock market index, for around 6 months before I switched to the bond markets. Now, allow me to say a few things. This was a different time back then. You could actually join a bank and then get faster into prop trading. These days it's all different, okay? As a trader at an investment bank, first and foremost, you will be engaged in market making, filled client orders, like he also did here. Okay, he just filled client orders. He didn't take any positions, any prop positions, all right? But even here, when he went to Diver and he could actually start trading in a prop way on a smaller scale, even that is something which these days will come for most traders after 10 years of market making at investment banks, if at all. You know, after the financial crisis 2009, a lot has changed, okay? Prop desks were closed in the investment bank industry. As a footnote, I myself once was very close to joining a prop trading desk at a major investment bank when I was still a student, but then after the financial crisis, that desk completely closed down, which is why I also had to adjust my career planning, because I wanted to get into prop trading back then already. Yeah. Okay, and how did that go? Actually, I was profitable right from the beginning. Not every day, but I never had a losing month in the 2 years I was at Diver. It was a very easy market back then. You couldn't trade that easily now. Okay, that's essential, all right? There's no doubt in my mind. After everything I know, I've read, I've researched, I've talked to people, you have to understand, okay, in the 90s, in the 2000s, the markets were different. They weren't that much manipulated either. There wasn't that much algorithmic trading. A big chunk of the market capitalization was manually traded. These days are over. You have to understand that, okay? Now that implies that if you read also books from back in the time, they're not valid anymore. In markets, things changed, and they changed structurally. By the way, as another footnote, if you're interested in that topic, there's a good movie, it's called Floored, which documents the transition from the physical floor traders to computer-based trading. Okay. Electronic trading hadn't really started yet. In terms of volume, the main activity was in London and on the LIFI, the London International Financial Futures and Options Exchange. On the DTB, there were mainly the arbitrageurs and there weren't that many other traders there. So sometimes it was really like having a free lunch. You could take the Bobble, 5-year German government bond, and it lacked movement, unlike the Bund, longer maturity German government bond. So the Bund moved and the Bobble didn't. So you just bought the Bobble and waited for some time for it to move. This may sound completely nuts for anyone trading these days, because a simple inefficiency like that would be quickly exploited by all the algorithms we have today. Well, surprise, surprise, back then many people could make a fortune just by simple arbitrage. Like some people did in the new markets, in the crypto markets more recently, yeah? At the beginning, the markets were inefficient. You could actually perform arbitrage, buy one Bitcoin at one exchange and sell it at another exchange and pocket the difference, like Sam Bankman-Fried did at the beginning. By the way, is another footnote here. Okay, so you literally could trade even the time lag between the bubble and Bund. Okay, can you imagine? These days are long over. Of course, today it's a very different story with all the algorithmic systems which arbitrage everything, so there's no longer this kind of opportunity. It was much easier trade than trading the news like non-farm payrolls. These days, automated algorithmic traders have their servers connected right next to Bloomberg's and next to the exchanges, so they've already reacted very quickly, much faster than someone can manually. There you go. At Daiwa, I was trading small sizes which were easy to get out of, so I had flexibility. I was mainly doing directional trading. So he was literally, performing prop trading at Daiwa back then. And as I said, markets have changed, banks have changed, the industry has changed. Unfortunately, it's not really possible to start a career like that anymore these days, as I explained. But look what is at his precise statements, okay? If the most successful retail trader in history tells you that, you better listen. If you don't want to listen to my videos. While you were at Daiwa, did you have a mentor? Yeah, there was one, though he wasn't necessarily a mentor. I was doing my own thing, like discovering technical analysis, and he was the head of the trading desk, and he was profitable almost every day. Actually, he didn't look at any kind of indicators as such, but followed his opinion. He would explain to me on a chart about where all these people bought and where they would have to get out. Footnote, like the market causality. You see the dumb money being long, you see the dumb money getting short, yeah? So it was like looking at the psychology of the market and reading it. He didn't trade much. He would be shaking his head saying you can get old trading like that. But I learned a lot from him about market psychology. You see, so he was a sniper, waiting for the right opportunities, low trade frequency. Can you give some insight into the tools and strategies you use? I've changed a lot over the years, and I've stopped the really short-term trading where I was trading a couple of ticks and doing a kind of market-making style. You understand? So what I told you before, you hear it from the horse's mouth, so to speak. So he doesn't, even back then, over a decade ago, almost a decade and a half, he didn't do flipping anymore. And not even scalping. I stopped this a couple of years ago because of potential regulatory issues and also because of the evolution of all algorithmic trading out there. Now you have the FBI investigating algorithmic trading because what the algorithmic traders do is market manipulation, but somehow it is legal. Does that ring a bell, ladies and gentlemen? Does that ring a bell? Okay, that's the smart money. That is the smart money. If I put in orders and then cancel them, I could be accused of market manipulation. But they do it in microseconds at the rate of hundreds of thousands of times a day, putting in and canceling orders, and no one really stops them. So here you hear what I explained before. Okay? So at some point after the regulation was adjusted, he was entering a legal gray zone, because you could say, oh, he's actually manipulating the market by flipping, putting one big order on one side, but then canceling it. And as you can see, the banks reacted by creating algos which actually hit him and filled him. So at that point, the flipping business was over. Okay? So for these reasons, I'm now doing more mid to long-term trades in a variety of markets and don't just concentrate on my core markets bonds, which I was doing until I stopped short-term trading. By the way, also see the mindset of this trader. He doesn't just try to short-term trade because he thinks it's a cool thing to do. He's about making money. So as soon as he saw that his edge is over, he left it. Think about that, okay? If you no longer have the edge, you just left the market. What's the point to be there if you can't make money and other people will rather take money from you? This may sound like common sense, but many people lack that common sense also. But I was always looking at technical analysis. I was never really a fundamentals follower, except for the news releases. I was always following the technicals and trying to read market psychology. The main technical analysis tool I use are point and figure charts. I was already using them 20 years ago, so this is the main one for me really. Now point and figure charts can be quite helpful because they reduce a bit of noise. But you can see, alright, fundamentals in the short term of course don't play a big role. We have elaborated on that in detail. And with technical analysis, he doesn't mean moving averages. We'll come to that now. So do you use indicators such as RSI, MACD, and other tools such as trend lines and support and resistance? Trend lines and support and resistance, yes. But I stopped using all the indicators like RSI, although I was using them about 20 years ago, but I never relied on them. But for very short-term trading, they don't really help much. That's more important is the market's behavior around support and resistance levels. Also, back in the old days, I was gaining information from my trading, having bids and offers in many different markets, and from my fills I could feel what the market wanted to do by how it reacted to my orders. You understand? So that is trading the order book in the futures markets, where you can do it because the markets are centralized, okay? You see what kind of orders are placed on the bid and ask side, at which prices, how many want to be filled on which side and at which prices. And how do they move, how do they react. So we would literally place many little orders like a boy just to see how the market reacts and whether there's an opportunity to scalp in one direction for a few ticks. Sometimes I would sell at the low and someone would laugh at me for doing that, but actually I gained information maybe by seeing there was a big demand at that level. If they lifted a big offer of mine, then I knew someone wants to buy and then I would try to go long. So it was very different thinking to what these guys thought I was doing. You understand? This is very equivalent to the market causality in forex today. It's just decades ago in the futures markets where he literally had to test the markets with small orders everywhere. How crazy is that? Okay. I'm sure he wished he would have had the causality back then. Just coming back to short-term trading, with all these algorithmic trading platforms in market, do you think it's now possible for small traders to make money out of scalping forex? Oh, interesting questions for us. If I was to start trading today, I think I would even do foreign exchange because I think it's really easy to do the real scalping for a few pips here and there, especially after some number releases or someone's speech. The forex markets can be really choppy. Of course, you must have some feeling for the market. You put in orders in a 5 to 10 tick range and you get filled on the bids and offers in this environment. Of course, you must have some tight stop losses. For retail traders, they may not be able to tell where the market is going, but they can use a good short-term volatility for scalping. How crazy is that statement? All right. And I love that the interviewer asked him that question. And now you can see everything makes sense. Hopefully something clicks up there for many of you, right? So he acknowledges the price moves we have in forex, and he even says, yeah, you would consider, to trade that. And of course, markets are choppy. And as you can imagine, since then, the manipulation has just increased, as I've documented literally on this channel. You can see how the algo manipulation over the years increased. Okay? Have you ever traded forex? I don't really trade forex, but I'm involved in it for money management purposes. Maybe I could trade it for short-term moves such as breakouts, but for longer-term trading and to predict direction, it's really not that easy because some news or someone speaks in the market can just go completely the other way. You understand? He was not aware of the causality back then. Okay, because the causality was published half a decade later, by the way. So how could he? But if he ever finds this and reads this, maybe he sees that everything makes sense. And that here on SMEFX, okay, I exposed the forex manipulation, the market causality, exactly like he felt back then. And we see all this as leading information with the MK Web. Okay, we see the stops which get hunted, the positions which get pushed away, the option strike targets which get filled, the order gap zones getting filled, the forward reversals, the short-term stop runs, the post-stop runs, pullbacks. We see everything, Paul. We see everything. Contact me and let's do something together. Seriously. New generation with the old generation. That would be cool. But unfortunately, I guess he made his money. He's not interested in new business. What's your typical trading day like? Back in the old days, when trading intensively, I would try and take regular breaks. I would be at the trading desk at 8 a.m. in the morning because I really like the opening trades, which were always very interesting. I would trade for 2 or 3 hours in the morning. Then there would be the US market open at 2:20 to 2:30. They opened and there would usually be some economic numbers released. At 5 p.m. it would usually be the end because the cash market would be closed in Europe. Of course, now they have extended the trading times of all these markets. It was a different time back then, you know. So I guess these days you come into your office, read all the news, look at the upcoming data releases and maybe plan your trading campaign? No. I never really plan a campaign. Of course I look at the charts, and if I see a really big level right at the open, then maybe I will plan something. But usually, if there aren't any special levels or something, then I don't do anything. Read this sentence hundreds of times. These are golden nuggets right there. And if you experience the trading, you will know that yourself. Okay? So, even back then, he limited himself to very, very particular setups. He wouldn't just look randomly for random trade setups. And what do we do in the market causality? We are very selective. We are snipers as well. We wait for our proven setups to appear and then we place trades. If there's an option strike target signal, we wait for the squeeze line to collapse before taking the trade. Okay? We don't place random trades. We trade to win. I can trade from nothing. Just give me a computer and some charts. For instance, I can see that some big news release is due because market liquidity has dried up. I can just trade. I don't need to study and prepare myself, but of course it's better to prepare. So normally I have my charts and I have the newsfeed running and squawk boxes as well. In the old days this was very important to me to know what news was coming, what rumors were going around and so on. This was especially so because I like to sit on my own away from the other traders. I concentrated better on my own. Okay, I used to have a squawk box for several years, but for more than 2 years now I don't have any because there's literally not much value in having someone giving you like news during the day because the algorithms have completely taken over the game. They will not just do random news neither if it doesn't fit the narrative, you see. So these days are over. And also what he says, remember, so what he did back then, that's not possible anymore, all right? To take a few ticks off in news trading. In forex certainly it's not possible because, as you know, it's all about the dumb money. If the dumb money is long, okay, no matter how bad the US news are, they will retest the low, okay? And if you don't see where the dumb money is and where the stops are, you can't know that. You can't possibly know that. It's an informational disadvantage. You understand that? So in forex, you can't just do what he says, okay? Be aware of that. That's what the dumb money does. Thinking they can trade a chart pattern, a historical chart pattern, or some news. It doesn't work that late anymore. Certainly not in 2024. What do you think separates moderately successful traders from very successful traders? I think everybody would say it's a discipline in money management, which is actually very hard. Many years ago when I was a diver, and even when I went off with some other partners, we always had someone who looked at our P&L. If you were down a certain amount, you would have to reduce your position size, and if you were down even more, then you have to turn off your computer. When I was trading on my own, I didn't have the benefit of that person enforcing discipline. If you have someone to do that, then it's fantastic because it's very important. Some days nothing works, and next day you come in and everything is fantastic. I remember when I was a diver, when I was having a bad day, the chief trader would tell me, you have blood in your head, and tell me to go out and get some fresh air. Very good advice, even valid today, okay? And it's the same in forex. On some days, you know, there's choppy price action, there are no proper setups, there's just house cleaning, okay? There's nothing to get out of the market. Don't try to forcefully get pips out of the market when everything is random. The markets are empty, the dumb money flow is low, there may be stops on both sides far away, okay? You don't have an edge, all right? And that's what he's talking about here. I used to get angry with myself, and when I made a mistake or something went wrong, but if you follow your strategy and lose, then it's bad luck. Sometimes I traded at times when I shouldn't have traded because it was not my market, but I still traded anyway and lost money. So in those situations, you may have strict money management, reduce your size, or stop trading for a while. Okay, that's of course the bread and butter. You need to have your risk management under control. And in whatever way you have designed your own setup, okay, whether it's involving someone else or having clear rules or saying if I lost X amounts, I will switch off the machines no matter what, stick to it. So I think when you're losing, it's good to stop and get some perspective. Talking about highly successful traders, then you have some more talented people who can really feel the market. So when the charts say you should go long, but then it doesn't go up, these people will act against logic and go in the opposite direction because the market will go the other way. So you need to be mentally flexible. This is another nugget, okay? Like you know from the market causality. Sometimes it looks, oh, the market came down so much, come on, there needs to be a reversal up. But no, longies are buying all over the planet. So the algos will go down again, okay? And some people, they have a better feeling for these things. Or they get stopped out on the longs and they are like, you know what? My analysis is wrong. I go the other way. But obviously, you can't do that all the time. Otherwise, you get whipsawed. So this mental flexibility, it's actually important. But there's a limit to it, okay? Otherwise, you will just get whipsawed and get stopped out on both sides. You know that. Tell me a bit about your scalping. I can tell you one day I was losing and trading 1 million contracts. Usually it was 100,000 to 200,000 contracts a day. That could be 100 trading decisions a day. So this is literally manual high frequency trading, okay? By the way, I wish this would work in Forex. It doesn't. But like personally, I would love to sit in front of the machine and click all day and then go home. In Forex, that's not possible, as we know. In some future markets today, certain setups may be possible, but it will take you years to see and understand them. I remember one particular setup from John from the No BS trading community, and after she leaves, it was called. It was more simple than that, though. You know, it was like after, you know, trades have been filled, you could trade the pullback and so on. I would have permanent fills on both sides. I was always feeling out the market, seeing how my orders were filled, and sometimes I would trade breakouts. So I was a scalper, sort of like a high frequency trader before the algorithmic systems came. Excuse me, so exactly what I said, yeah? It was literally manually conducting HFT. And by having little trades everywhere and you get filled, that gives them information, oh, maybe here I can do a scalp. Again, in Forex these days you can't do that. Apart from the fact that Forex is decentralized, as you know. What you say are the main differences psychologically between scalpers and long-term traders, as you have done both. Listen, by the way, you see this is an old interview. Look, they're really good questions. These days everything is so silly. Seriously. In what time are we living in? Everything is superficial, shallow, BS. Nobody digs deep and really goes to the bottom of this. Really, I'm not part of all of this. I'm not, okay? Call me a Quaker, whatever, I don't care, but I can't identify with this. Either you want to go really deep, okay, and ask good questions. These days, everything is just blah, 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 blah. Cheap talk based on nothing. Oh. I think it's a good questions here. I love it. I think it's even more stressful if you're a longer term trader because you hold the positions that might be wrong and not going your way. Something can happen overnight, and I think you need stronger nerves. I completely agree with that. Okay, I find longer term trading is even more stressful. And most of remaining trading is like, even on the lower time frames, trades can still take 2-3 days. I try to close everything on a Friday, and that works for me. But even having open positions over days can sometimes be stressful. And in the long term, I agree with what he said. I find it easier to be able to close your positions and then start fresh on a Sunday or Monday. Interesting you say that because some people I've spoken with think scalping is more stressful because of the amount of trading you do. You must really like scalping to do it. It never affected my heart rate, but it did have some digestive problems after a while. To be good at it, you need to be able to make decisions quickly. So, for example, I would sometimes buy and then look up the news to see what had happened to move the market. Other people would read the news first to decide what to do, but that would be too late. Okay, again, it doesn't really work like that. Even if you do the short-term trading with the market causality in Forex, often you have even hours to execute a trade. Sometimes you have to be fast. The thing is, you have to, like sometimes you wait a few hours just to have a very short time window where you could have done the trade. And I personally love short-term trading, but today, in the markets of today, it's even more necessary to have the patience. Even as a super short-term trader, even as a 1-minute chart trader, you need to have the patience. You can't just click the button all day. In German we say, links, no, what was it? I forgot, there's a saying. Left and right, pockets empty, something like that. Buying, selling makes your pockets empty. How has moving from short-term to longer-term trading impacted your swings in profitability? That is a hard question. When I started out and I was telling you that I had no losing month, that changed when I increased the size of my positions. Sometimes I would get hit badly because I had a huge position. Now I have much smaller positions in many more markets, so I maybe don't have so many swings in P&L. You understand? This refers to the topic of scalability, and I've talked about it before. The truth is, especially in forex, by the way, you may have a strategy which is profitable on a small account. As soon as you scale it up and you put a few millions in, the profitability decreases, and that's very exclusive knowledge, and people will not tell you that. Okay, and there are limits to scalability. I've talked about it before. The ones who follow me, they know all the things I've said about that topic. I will not go into depth here, and that information is relevant for a very small group of people anyways. But of course, if you try to increase the normal strategy, the profitability decreases, so you will have the losing month. And that's still true today. So you're pursuing a diversification strategy. Yes, this prevents big P&L swings. With the big positions I used to take, it could sometimes be hard to exit them. Again, scalability. The worst I had was in 2008 when SocGen, the French bank, was liquidating contracts accumulated by the trader Guillaume Caviel. That's the rock trader. He lost 4.9 billion euros. They were selling his positions in the DAX and some other Euro stocks, and the market dropped something like 1,000 to 2,200 points in 2 days. So I bought into the market a couple of times and got hit badly because liquidity was down. I think there was a US public holiday as well. So you see, like, even with this approach back then, in a black swan scenario like that, he got hit. That's not a surprise. That was the rock trader, by the way. Of course, in the markets, by the way, you know what's equivalent in the market causality? Squeezes. When for some reason, like we had in dollar yen last year, etc., when shorties come in, and the market goes up. If you're trying to foolishly scalp this down, of course you will get hit and lose a lot. Okay, look how you see all these things in today's world by the causality. I'm proud of that, I won't lie, because that's kind of my life achievement for my finance career, to put this together and expose that. And also, this moment here to talk about the topic, I've waited quite a while, so that's a special moment for me right now. It must have taken you a while to recover from that. Yes, I lost badly those 2 days. I was on my own, I didn't really have risk management, and I should have stopped, and I just couldn't believe what was happening, so I would buy again. That's what happens when as a trader you're losing it a bit, and you're not in control, you don't have the discipline. Everybody has their weak moments, and that's one of them. Which traders do you most admire? When I started, I admired Tom Baldwin, a bond trader often credited with being able to single-handedly move the US Treasuries market, who traded on the Chicago Board of Trade, but I didn't know that many traders at the time. But I knew of these traders in the trading pits we were listening to on the Squawk Box from Chicago, London. At that time, Baldwin was a big trader in treasury bonds, so when someone said Tom is on the bid, then everyone would start buying. It was always important to know what he was doing. Of course, these days are over, but when we still had the physical trading floors, it was literally how the markets were, paying attention to specific people doing specific things. Can you imagine? It was a completely different time. These days, with all the algos, the computers, I mean, it's very, very different, okay? It's a different phase in market history. Which books about trading would rate as among some of the best you've ever read? Definitely Market Wizards and some of the other books written by Jack Schwager. Something I've said many times, yeah? Market Wizards, where he just interviewed some successful traders with different backgrounds. There are 3-4 different books these days. I recommend them still. Read them. Read about all of these people. There are also newer versions of the book, but even the old ones, even the ones going back quite a while, read all of that. Okay, that was the first books I read. And it's kind of the equivalent of the Chat with Traders podcast these days. These days people watch podcasts, they don't read so much. And, Chat with Traders, they interview successful traders and all that. But back then it was all books, ladies and gents, okay? Books. I still have loads in my place, but I mostly give them away to friends and stuff these days. But yeah, I mean, Market Wizards, even today, is very relevant, even no matter what you do in the markets. I also really liked Technical Analysis of the Financial Markets by John Murphy. Also an interesting book. I haven't read any books recently about trading, but 10 to 15 years ago, I read a lot of books about trading. There were a number of books I read about point and figure charts, which I really liked, but I can't remember the titles. But the Market Wizards books were really good. It was great to find out about these different traders in different markets. It was very interesting to hear about the psychology and the different trading styles. I also read George Soros books, such as The Alchemy of Finance, which was a fantastic book. So you see what I said at the beginning, that mindset, I mean, if you're serious about something, that's a mindset you should have. Not short-term, shallow, half knowledge, okay? And BS, just trying to talk what you heard from others. Oh, man. Don't get me started again. George Soros books, well, I read The Alchemy of Finance. I have to say, it was not what I expected because it was more like a trading journal. And most of the entries were like, today I decided to increase my holdings in stocks and to reduce bonds. George Soros is a topic on his own. If you ask me personally, he had some kind of insider knowledge. That's my personal opinion. I should maybe one day make a video about this. But not in the mood right now. But yeah, back in the days, people read. Today, people watch more, which is fine. People watch podcasts and YouTube and stuff. And I publish on YouTube. I also watch it. But believe me, if you want to go into depth, it's always better to read, okay? Go to the source, all right? Learn from the people which have been there before you. And respect and honor them. That's another thing, okay? You remember like ICT stealing, even set up some other people like from Larry Williams and all these things. I mean, I hate that, okay? I hate it. Have the respect and honor people. If you take people's work, honor them by saying this is from that person, all right? And not just steal their work like ICT did, by the way. Another footnote. As you can see, I live in the world of today, so I need to make those comments. What would you advise someone starting to trade today to do? Depends on what they want to do. The scalpers are more likely to be people from the street, not necessarily the ones from the universities. For a very smart guy with a good idea of markets and valuations, then I would advise him not to scalp. 20 years ago it was fantastic, when there was no algorithmic trading. They have taken the easy money off the table, they just front run and arbitrage everything. I agree with this statement 100%. If you do not have the market causality, don't do short-term trading. Because you won't have a chance. The algos will eat you alive, and my whole work here is proof of that. Okay? An arbitrage of, I can tell you a horror story of someone I knew. He was trying to create a forex arbitrage algo and it blew up. I had bought it before. I said, I don't believe this will work. You will pick up pennies in front of a steamroller, and that's what happened. Black swan, you get wiped. Okay? And even banks will see when you try to arbitrage and they will wipe you. So that's my personal advice, don't do it. I think it's scalping a much harder playing field for someone just starting out. Today I would recommend people go for longer term trading or go for an investment style approach. For scalping, I think some of the less liquid Asian stock markets where the algorithmic traders aren't operating in the forex markets are a good choice. As I said, since then this has completely changed. Okay? Forex markets are the most manipulated market in 2024. Okay? That's why the MK has gained significance. Any final thoughts about trading? Yes, I would say trading is not really for humans. I 100% agree. When they are profitable, they become cautious, and when they lose money, they start taking more risks and lose more, which is the exact opposite of good trading. So a person must decide if they can take risk and if they can take and can make decisions quickly. I 100% agree. You know, like your human intuition of an average person with an average IQ is exactly the wrong thing to do. That's why traders often do exactly the wrong thing. They buy and sell in exactly the wrong moments, and they end up on the dumb money side, okay? And that's what we know best. So I loved that interview. I have a second one, and you know what? Let's go for it. Let's also read the second one. But just to comment what I said and to put it all together, you see where I'm going with this, yeah? What Rotter did back then, the flipping, he was exploiting an inefficiency in the market by manually scalping and flipping all day in the futures market and collecting 2 ticks 70, 80, 90 times. Okay? If he would lose, he would also quickly get out and take a small loss. Then later, the markets changed. In my opinion, the banks became aware. They went after him. They put algos. His strategy got destroyed. But he adapted. He went more long term. So you see, these are really some golden nuggets here in this old interview, which are still valid today. And you can see why this gentleman has become one of history's most successful prop traders. Before stupid prop firms were even around in terms of simulated trading and trading challenges, by the way. And I'm not against them. It's good that, you know, we have that also. Just as a little snappy comment here. Okay, next interview. You have a reputation for trading the Bund along with Bobble and Schatz interest rate futures. What are you trading now? Is your emphasis still in Europe? I'm still trading mainly the Bund and Bubble, but also heavily in the Euro stocks because it's very liquid most of the time. Generally, I like markets with high liquidity. At the moment, I'm also relocating to Singapore and I want to explore new trading opportunities in Asia. I'm becoming a member of SGX as they offer a variety of interesting products and the officials are very customer friendly. So this is an interview from 2010, so a bit later. According to one report, you and Oliver Kinski first started trading on your own with 1.3 million in capital. Does one need more or less to start a successful trading operation today? Oh, well, after question. At that time, we had some minimum margin requirements from our clearer. We were a DTB member and we were thus connected directly into the exchange. There was no possibility for a pre-trade position limit. Therefore, the clearer had to trust us to not overtrade. Today, the brokers offer you all kinds of trading software where they can set your limits based on your buying power or position size. That's very interesting. And you see, of course, these days are over. Okay, the broker gives you a margin. If you get over leveraged or something, you will get a margin call and you will simply get stopped out and your loss will be realized. But back then, of course, if you're also an exchange member, you know, was a different story. Very interesting. Therefore, I think as a high-frequency intraday trader, you could start with 300,000 euros and aim for a profit of a few thousand euros every day. If you plan to hire many traders quickly and want to trade on many different exchanges, you would need more capital, especially if you need a membership on some exchanges. It's also important to choose the best location with the best technical infrastructure, low taxes, and a trader investor-friendly environment. I think the best places for traders right now is Singapore. It's growing rapidly and has a great lifestyle, very safe, with the best schools and world-class infrastructure. Yeah, I mean, 300,000 euros, that seems very low. Of course, if you can do short-term scalping like that, being part of an exchange and so on, it may be feasible. I personally, if you want my opinion, and for Forex, do not even think of starting a hedge fund without an initial trading capital of, let's say, 3 to 5 million euros. Better 5 million euros. That's my personal opinion based on experience. Okay, and I didn't know these things back then. But literally, you know, considering all the costs, okay, you will have running a fund, which can add up so quickly these days with compliance costs and all kinds of things bringing you bills every month. You need a few million. All right, that's the truth. You don't want to over leverage. Even short-term trading, you don't want to risk too much per trade. You know, we're not doing order book scalping in the futures markets like that. So it feels too low. In Forex, even if you take the friends and family route, my personal opinion, don't start below a few million euros. I personally made that mistake a long time ago. And, okay, so do not even think of doing anything like that with a few hundred K in Forex. In those markets, depends. It could be feasible. 2 statements from your website caught our eye. First, you state that total control is an illusion, and then you say machines cannot yet replace highly skilled people. How do you balance the use of technical and algorithmic trading with the input of human judgment? Likewise, when it comes to risk management, how much do you rely on computerized risk assessment as opposed to human expertise? Great question. Addressing the second point first, I do all my short-term trading manually. Wow. For our longer-term positions, we use computer-based models that generate automatic entry signals. Interesting. So he doesn't use bots for the execution. He just uses them for signals, but he always clicks the button manually. Nice. My traders can exit 2/3 of their positions at their discretion, and the rest is liquidated when the exit signal is generated. These are mainly trend-following strategies, and there could be good fundamental reasons to exit a part of the position before the trend reverses. On the other hand, risk management must be computerized as there is no place for emotions. Total control is an illusion means that, for example, an exchange margins are based on recent volatilities, and when some sudden unexpected event occurs, it could blow out a lot of traders even though the risk models were working just fine for a long period. again, we have golden nuggets here. I agree with that. Okay. As you can see, he seems to manage other traders. At least he did back then. Not sure what he does these days. But that makes sense, yeah, to set the risk policy in stone, to make sure that no emotions get in the way. You see, this is how professional traders operate, okay? As opposed to rookies, so just saying, I now put everything on this trade to recover my losses, and then they blow up, okay? That's dumb money. Here you see the mindset of professional traders who try to get somewhere in small steps. They don't try to get rich overnight, okay? Don't be a stupid rookie trying to, gamble around just to lose it all, like the brokers and many prop firms want you to. Where do you draw the line between trading a market and manipulating it? Nice. This is the best question for all the regulators. The answer is very easy. There is no line. If you buy just one contract, you already affect the market, especially with all the automated systems. You know what that answer reminds me of the hearing where, after the financial crisis, where they asked Lloyd Blankfein, the CEO of Goldman Sachs, in Congress, and he came up with a similar answer, which is a bit cheeky. Of course, you could argue that every single trade affects the market, but when we talk about market manipulation, we talk about a market participant who is able to push the market in one direction consistently, like the smart money does in forex, yeah, like always pushing against the dumb money, going for the targets when not many dumb money traders win, etc. But I agree with that generally. I mean, it's not that simple. I mean, that's also why we have a gray zone regarding market manipulation in legal terms. It's not necessarily illegal. Still, we also know that many big players like banks get fined every few years for just a few billion for forex rigging. But then it's also on a case-by-case basis. What kind of rigging are we talking about? Sometimes, it's manipulating the market in certain times, depending on the interbank interest rate, etc. Let's not get off topic. If you enter a small buy order below the market and cancel it couple minutes later, you always can see an immediate reaction in the order book. Today, the algorithmic systems permanently enter orders and delete them very quickly to enter them again a second later. So what is manipulation? In my opinion, there should be very clear and specific rule for this topic. Yeah, but the truth is that's very difficult to do, right? To come up with very precise rules. It's true what he says. And as you can see, algos are flipping these days. Apart from doing all kinds of other things. Placing, even the stocks, by the way, yeah? Placing fake orders, cancelling them, trying to create the impression that there's interest to buy a stock. There are many manipulation games these days, all right? And they're different from market to market. In Forex, we know how this works. In stocks, it can often be to create fake interest in a stock. In futures markets, like you say, it can be, the orders get cancelled. It's literally the cat chasing its tail. And these days, trying to manually scalp on that is almost impossible, by the way. Yeah. You were once known as a flipper, a term that arose from distrust of short-term traders. High-frequency trading has been suspect in market distortions in events like the May 6 flash crash. Do you think people are more or less skeptical of short-term trading than they were 10 years ago? Basically, 10 years ago, fully automated trading was not allowed, and only locals were doing short-term trading and providing liquidity. The typical locals were some unshaved guys sitting at arcades or smaller prop firms, dressed in just surf shorts and having their breakfast, lunch and dinner at the desks. Today it's very fashionable to get involved in high-frequency trading. My guess is that 70% of the volume is generated by algorithmic trading systems, so you can be sure that there will be more flash crashes or flash squeezes in the future. This could be great fun for some locals, and there we come back to the manipulation topic, as the flash crash was obviously caused or supported by the machines. In my opinion, people, especially regulators, will get more skeptical about this type of short-term trading. By the way, coming back to Forex, did you realize that we didn't have a flash crash or fat finger squeeze move for quite a while? Because why should the smart money do it? The big flash crashes we had were all against the dumb money. Always! When we had dollar yen going down 300 pips in a few seconds, okay, in 2016, the dumb money was long. When Euro Swissy went down thousands of pips before, dumb money was long, okay, I've documented that. But why should they do it these days? It would be too obvious. They can just do their normal market manipulation with normal price moves. You understand? There's no need to do extreme moves. They have become more and more rare. Oh, I love it. I didn't know that this will be so much fun, because right now I'm able to comment, you know, from the perspective of Forex today. Amazing. Back in the 90s, so-called SOES bandits were criticized for gaming Nasdaq small order execution system. Is there an equivalent of the SOS bandit in today's world of electronic trading for traders with relatively small amounts of capital, that is? I think it will be more and more a battle between machines, where the better ones try to destroy the smaller ones by learning from their behavior and trading against them. I agree 100%. In the old days, there were quiet periods with no data flow, but today one machine can create a trend and the others will follow. Today's sheep are also machines. I'm pretty sure there are all kinds of similar bandits in the different electronic markets. Yes, 100%. And here we talk about the smart money also fighting against the semi-smart money. You remember Alpari? Alpari wasn't part of the big boys club. They were semi-smart money and they got finished off by the real smart money, okay? Look up that case if you have no clue what I'm talking about. Now, absolutely true. And I mean, if you have any automated strategies on the buy side these days in Forex, of course they will get slaughtered if they trade on the dumb money side without understanding how this game works. This is not new information. How helpful are $250 Forex mini accounts and products like the CFD contracts of difference to individuals who hope to parlay a small amount of capital into a fortune? Are these valuable tools or just the malt liquor of the financial world? Great question. Also very relevant now where, you know, the US has banned CFDs for American traders, as I've said before. Amazing how history, how things change in history all the time. In my opinion, this is just a kind of gambling similar to online poker. I know some smart guys who consistently make money in online poker, just taking it from all the gamblers. If you're not just a gambler, you need some professional equipment like news feed, etc. And then with the right strategy, you might turn even a small amount of fortune. He's talking about the market causality. As simple as that. You need the tools, okay? And if you don't believe anything I say for whatever reason, then believe please the most successful trader. I love this. And I agree 100%. And when you are an MK trader, you are trading against the dumb money, because you will not end up on the dumb money side getting stop hunted. As simple as that. And the dumb money, they are gambling. They are not really in charge of their activity. They just trade in the worst way. And the market takes the money from them. The smart money. Now we are not the smart money, but by being aware of all this and understanding all this and how this interacts, how the mechanics are, we can avoid falling victim to this. You understand? The biggest problem with these products is that you do not trade on an exchange and it's not regulated. True. That means your counterparty is the broker who probably doesn't even hedge your position. So if you are too successful, the broker won't like you and kick you out or just not give you good fills. I've heard many stories like that. The broker is your counterparty. You must accept his prices and his fills. So basically, it is more liquid for these brokers and not for the financial world. And you know what? In this sentence, you could replace the word broker with prop firm in 2024. You understand? It's true. Any desk-based brokers trading against their clients want you to lose. And they will manipulate the spreads and slippage against you. And the prop firms do the same. Surprise, surprise. That's why this channel here is for traders. We exposed all that. I've shown you all kinds of things over the years, even broker mispricings and how this could be exploited live. All kinds of things come to my mind. So back then it was all these retail brokers, you know, going against the clients. Today we have also prop firms who want to earn the challenge fees and do dodgy, shady things against the clients. Footnote, SFT who closed now, my Forex funds who still in court. Watch my other videos. You definitely have much better chances playing online poker as this is a level playing field. I agree. Long-term capital management. Andrew Merriweather said in an interview with Michael Lewis that the downfall of LTCM was partly a result of copycat activity by executing brokers the firm had to use after the traders left Solomon Brothers. How do you avoid losing your secret sauce to institutions that clear or execute your trades? Great question. You have to understand, that's what some people don't get. Even in the world of stocks. Okay, think about it. Big hedge funds having billion under management. How do they execute their trades? With prime brokers. The investment banks, top tier, second tier, etc. Now, the traders on the bank side see the positions the hedge funds are taking because they execute them. Now, who wants to claim that there is no leakage of information regarding that? Now, in the 80s, most brokers were front running. They saw a big order coming from a big hedge fund. They saw they buy the stock, so they bought on their own account first because before filling the order, pocketing the difference. Front running. This became illegal. Okay. These days, I'm sure there's still front running going on, but they are taking a massive risk. They can get into trouble for that. Similar to people who can get into trouble for insider information. And as a footnote here, look at all those politicians like Nancy Pelosi who have insider information from their political activities and are literally monetizing it with their trading, which is absolutely crazy. I should make a video about that topic only, which is so unethical, and hopefully it will be made illegal. But the ones in charge who make the laws, they are pocketing the money, so they're not interested in regulating themselves. That's how the world works, unfortunately, okay? In the Matrix, people want to fill their pockets, unfortunately. But, okay, what I said before. So, you have to understand when a big hedge fund places big orders, of course, this gets seen by the market, all right? So that's a delicate topic, and hedge funds use different brokers and split up their orders and whatnot. But there will always be some information leakage, if you ask me. Look what Rotter says. Unfortunately, I've always had worries about other participants watching my activity. It could be the clearer, the broker, the software provider, or even some technical staff at these companies. The main protection is to have accounts at different brokers so nobody knows your exact positions, what I just said. Generally, I try to get in and out of large trades pretty quickly to avoid that anybody attempts to trade against me, but I'm never sure. And I personally, before I became a full-time trader, I was a broker, as you know, stockbroker. And I remember, yeah, on the other side, seeing like, because you see all kinds of people, you see who loses, who wins. You know, so you're going to see who is losing money, who is making money, what positions they take. And of course, there's regulation in place. Yes, I mean, this is very delicate. You have to treat all kinds of information according to the rules, the regulation, the law, etc. But as a trader, you can never be sure, you know, where information is leaking. And for Rotter, this could be detrimental because remember, if your trades are big, of course they get seen, and that's what happened. The market saw the big flipping positions, and they made arrows to fill him and to hit him, and then he stopped the flipping back then. Yeah, information is everything in markets, all right, and we know that. Your website says your core competence is in trading financial derivatives, especially options and futures. On peak days, we trade contracts on the bond markets with a total value of up to 50 billion euros, more than many major banks. Are you concerned that Basel II and other ongoing regulation efforts will make it harder to trade on such a large scale? Oh, this is crazy. This number doesn't necessarily mean big position sizes. When I get heavily involved in the markets, I executed hundreds of trades quickly in a few hours. This is real high-frequency trading. I've been doing this now for more than 16 years. I've never really had a problem with any regulators. I'm basically a human liquidity provider, which is important for any electronic market today. And there's some truth to that. Okay, it's like as if he is basically a market maker because he got so big. Can you imagine? On the other side, whether other traders buy or sell, he may be on the other side. And, you know, it's as if he became the smart money in those markets, you understand? Now, he may not be able to move the price like the algos do in forex, but of course, by being such a big trader in a centralized market, you could definitely argue that he is, of course, a liquidity provider. Yeah, no question about it. But you see how this all comes then down to the information game. What happened to Greenhouse Capital Management, the firm you formed in 1998? Did you learn anything from that experience that you would want to pass on to others attempting to start a trading business involving a smaller number of traders? Greenhouse was a tremendous success for a short period of time. Originally started by my good friend Oliver Kinski and Michael Maranek in Dublin, Michael Maranek. That rings a bell. It brought together some of the most active, creative, and successful prop traders of the day into one company. It was a victim of its own success in a way. We wanted to raise capital to bring in even more traders and increase our market presence. We were positioning ourselves for an IPO when the tech bubble burst in March 2000. The banks, not unlike the reaction to the economic turmoil of the last 2 years, pulled in their horns and the situation changed overnight. We went from 8 to 10 banks courting us to no one even returning our phone calls. From that point, everyone in the company was thinking different things about the future, so we decided to wind down the company and go our separate ways. The advice I would give others in a collaborative effort is to clearly define your objectives. Make sure you will be fairly compensated for your best efforts. Stick to what you do best. Keep the structure clean and don't depend on others to make it happen. Oh, I could say so much about that. I mean, I myself, having been involved in different entities over the years, yeah, I've seen it also a lot. Like partners coming together, partners ending up fighting against each other, getting into long disputes. And as you can see, there's always a historic context. That's true for us now, yeah? Look how fast things can change regarding meta quotes, regarding regulation, CFDs. That was the same back then, okay? It's all about timing on a big picture scale as well. And as you can see with the tech bubble, then they didn't end up raising capital which they planned. Interesting. Is the overall mindset of the market and the sheeple trading in it different? Sorry, it's late now. Oh, it's almost 10 o'clock local time. Is the overall mindset of the market and the sheeple trading in it different than it was 5 or 10 years ago? Today the herd is the computers, and I think they're doing very well being the herd. The trends created by them are more dynamic than before. They can reverse their mind very quickly and follow the opposite trend immediately. So I would call them the dynamic herd. Nice. Would you invest in BP if you had to do so today? I had an investment in BP for many years and sold it a bit too late. I won't invest in BP anymore, but it's great for trading. Wow, I loved it. Thanks for your time, ladies and gents. You see, please always do your research if you're serious about something. I don't see anyone doing it out there, and I'm sick of it. I'm sick of all these YouTube traders, who are just engaging in scams and just try to do whatever it takes to get more reach, making nice 4K videos, but not investing some hours in doing research and understanding the history, not knowing in what kind of footsteps they step into, not knowing about interesting cases, successful people, books, everything which has been before them. It's like as if there's a gap, because the medium changes, and before it was all more written knowledge, and today it's all like video and visual knowledge. There's a gap, like much of the knowledge from before doesn't really get transitioned into today. But that can't be. It's our task. Anyone who does this work here publicly on YouTube, the onus is on us to make sure that there's not that gap, that some of the knowledge gets more popularized, all right, that people can understand the big context. Go back in history, look at successful cases, at failures, what happened, understanding what happened, and you will realize that everything kind of repeats. All right, it kind of repeats. All the things which Rutter said, especially here in the first interview, you understand they're completely true for forex today. All right? Anyways, Rutter, if you see this, contact me. Let's do business. The MK is what you did back then of today in a different way. We see how the manipulation works and we can protect ourselves against it. It was a long way to get there. Many, many years. Anyways, I'm still impressed by the whole story, and it all makes complete sense. These days, the algos have taken over. When it comes to forex, they have completely taken over the game. That's why your chances of success are close to zero if you do not have the right tools, if you didn't do your homework. Some things are timeless, such as discipline, mindset, psychology. These things are timeless. Okay, it will always be that way. Of course, you could argue that these things are also required for any business, for that matter, not just trading. And most people who are not really willing to commit to the game in terms of time, effort, energy, money, they may be better off just doing long-term investing, all right? It's another thing to consider. But if you want to go for short-term trading, all right, and trade the low time frames in Forex, you need the MK web, you need to do your homework, and then you have a chance to win against the algos. We are the last human response to the algos. Okay? The algos took over the game. They control it. They can decide whether pound dollar will go up or down 20 pips. Now, they can decide that. We can't. But in the MK space, you can trade manually by following the causality. That way, you can exploit the algos rather than getting slaughtered. This is serious business. Alright? So take it seriously. Don't make it an expensive hobby like most gamblers and most money traders do. I hope you liked this video. All the best to you. Take care.